On the heels of 4 straight weeks of selling, back-to-back negative months, and a down quarter, Congress avoided a shutdown, sending a continuing resolution to President Biden, who signed that legislation late Saturday evening. Speaker McCarthy opted for a compromise which offered $16 billion in disaster relief, but no aid package for Ukraine. Absent from the legislation were border security measures Republicans hoped to push through. This, of course, sets up for a battle between the Speaker and House conservatives. Matt Gaetz, Republican congressman from Florida, has threatened he will make a motion to vacate the chair. While the political theater plays out in Washington, markets head into the final quarter of the year, rattled by 10-year yields hitting the highest levels in 16 years. Welcome to The Money Runner. I'm David Nelson. High on everyone's list of concerns is a 10-year yield much higher than the levels it took to trigger the collapse of Silicon Valley and signature banks. At this point in the cycle, the yield curve steepening was supposed to be good news. It was just a few months ago, investors were looking for the first Fed cuts sometime this quarter. That, of course, has been pushed out close to a year. Unfortunately, the steepening of the yield curve is happening for all the wrong reasons. Bond traders are demanding higher yields to extend duration. Deficits, debts, and the cost to service that debt are colliding with a near dysfunctional Washington. While it's tragic when Americans can no longer talk to each other because of their party affiliation or social views, in government, that level of polarization is fatal. The good news is that stocks are a discounting mechanism, and maybe the carnage we've seen in the last few weeks has priced in the bad news from the last FOMC meeting. Back to basics. We block, we tackle, we run the ball, and occasionally throw one deep to the end zone. Where will we get our direction from? Easy. Gone are the days of starting off your morning looking at your iPhone to see what Apple, Tesla, or Amazon are doing in the pre-market. They don't matter anymore. The first place we all look is interest rates and oil in that order. If 10-year rates continue to rise, we've seen the highs of the year. If they can hold or inch lower, then maybe we can claw back some gains. It may not be that way every day, but I'll bet dollars to donuts that's what will play out for the rest of the year. What did the charts say? At its worst, the correction was 8% on an intraday basis. At least for now, we've held the trend line and are still living above the 200-day moving average. Recent price action wasn't exactly a confidence booster. Get out the new playbook, go right to 10-year yields. That's where you'll get your direction from. Welcome to the final quarter of 2023. As always, if you like today's podcast, hit subscribe. And don't forget to visit us at themoneyrunner.us. Thanks for joining. I'm David Nelson.